This is a clock, and we all trade around it and hear a million opinions about it. And some say only trade the open, others swear by power hour. Everyone's got a hunch, and we all have heard just trade when it moves story. Those are guesses. But I wanted to know, based on data, when the best time to scalp actually is, no matter what kind of trader you are. So I'm pulling intraday data to find the best time to scalp futures. I'm Errol Coleman. I've been trading for 7 years, and about 90% of my decisions are rooted in data. And at the end of this video, I'm gonna take advantage of intraday volatility with a live trade using key findings from this study. Before we get into the data, we need a couple quick definitions so that this all makes sense. What is scalping? Capturing small intraday moves in seconds to minutes. Same market, same logic. The only real difference between scalping and swing trading and long-term investing is how long you hold the position. The only real difference between scalping, swing trading, and long-term investing is how long you hold the position. So if I'm getting in a position and out of a position within 5 minutes, that would be considered a scalp. If I'm getting in a position and out tomorrow, that would be considered a swing trade. If I get in a position today and I get out next week or next month, that's still a swing trade. If I get in today and I get out in 6 months, a year, 3 years, 5 years, 10 years, that would be considered a long-term position. Now, this matters in the context of the video because most people get this misconstrued. A lot of people say, stay away from scalping. You shouldn't scalp. You shouldn't do this. You shouldn't do that. But it's the same exact skill sets in psychology applied in scalping, swing trading, and long-term investing. The only difference is the time duration in which you're actually holding the trade. Why order choice matters. The market moves because participants are buying and selling, and there are two order types you need to know to fully understand liquidity and how market participants interact with each other. Market orders are aggressive orders that get filled instantly and take liquidity from the market. So if I were to use a market order right now, I'd get filled at whatever price the market is currently trading at. And limit orders are passive orders that get filled once the market reaches that specific price level, and they provide liquidity to the market. Now, if NASDAQ was trading at 23,000 and I have a buy limit order for 23,100, the market won't fill me until the market reaches that price level. And this matters because every buyer needs a seller and every seller needs a buyer. And this is a process going on behind the scenes. Market orders are what comes in and fills limit orders. As a scalper, I need to get filled as fast as possible. So I often use market orders. The window of execution is sometimes really small, and if it's within my risk profile, I'll enter the market at the current market price. I use limit orders when I'm keen on a specific level and want to be sure to lock in the price that I want. Better entry, lower slippage, but the risk is no fill. But here is where this all comes together. The most conducive time of day to scalp. If you want the thickest liquidity and cleanest fills, it's supposed to be the first 2 hours after they open. That's the theory you hear all the time in trading circles. But here's the thing. Just because everyone says it doesn't mean it's true. I didn't want to just accept it at face value. I wanted to test it. So I pulled the last 365 days, broke down session into 30-minute increments, and stack the data together to see if the open really is the best time to scalp, or if the market has more to say. So the question is, does the data confirm the theory, or does it challenge it? And sure enough, the story pops right off the chart. At 9:30, it's a floodgate opening. Volume and liquidity spike immediately, and for the next 2 hours, the bars tower over the rest of the day. This is where fills are clean, spreads are tight, and scalpers have the ability to get in and out of trades with ease. Now, by the time we get to midday, activity pretty much just slows down. That's all. And honestly, it's a pattern we've seen for decades. It's just human behavior. Traders take breaks, funds pause execution, decision-making slows down. But if you zoom further, you see something interesting. Around 2 p.m., those bars start climbing again. It's not the same explosion as the open, but it's real secondary surge. Another window where liquidity tightens and trading conditions improve before the close. A year's worth of data makes it clear. The open is where the bulk of activity happens, but the context the data gives us is just as important. It shows the rhythm of the day, highlights when liquidity fades and when it comes back. And with that context, we can make better decisions about where to focus our energy and when to step aside. The data doesn't just confirm what traders think, it gives direction. So after looking at a full year of intraday data in 30-minute increments, the behavior is pretty clear. The open gives you the best liquidity and fills. Midday slows down like it always does, and then there's usually a little pickup into the close. The main point is the data gives us context. And that context helps us decide when it's worth leaning in and when it's better to just sit tight. And that's the whole goal. Trade with more clarity and less guessing. What's going on, guys? The market just opened a few moments ago, like 10 minutes ago. Our area of interest right now, I'm going to mark off, but it's going to be 23,875. And there we're going to look for some potential short opportunities, but we're not going to jump in right away. We're going to wait for a little bit more confirmation before we do that. And then we're going to use our ladder over here on the right-hand side to be able to manage our risk in our trade. Once we find our entry, we're going to use a market order to enter the market. And then we're going to go ahead and put in our stop order. This trade that I'm going to show right now, whether I have to manage the trade, manage my risk, or if I manage it in profit, it's a mean reversion trade. So if we trade up to that 23,875 level, I'm going to be looking to get short, right? Reverting back to the mean. It's a mean reversion trade. So I'm going to be looking for a reversal. If we don't get the reversal, I'm going to manage my risk. I'm going to show you how I do that. And I'm going to use the stop loss orders. I'm going to put it on the ladder function on this active trader version 2 tab. There we go. See, we just got that really quick pop in the market. That volatility will kick in at any moment. All right, we're going to be looking to get short here in a moment. We'll get short one right here, see if we can get filled. So we just got filled on one contract on the micros. I haven't found I like to call it the IP. I haven't went over this too much, but I like to call it my invalidation point. Knowing where your invalidation point is the best tool to know when you should not be in a trade. So my invalidation point is not very obvious right now, but I will show you what it is. Right now, the invalidation point is going to be if we continue to rip about 10 to 20 points against me, I'm going to stop out of this position. I typically like to have my invalidation point. For this specific trade, it's going to be at this high if we end up putting in this high. I'm getting a little bit of a pullback now. We're going to look to cover around the morning lows. Now, because the market has pulled to the downside like this and we're far away from our initial stop, now I'm going to be pulling my stop loss, which is about 10 to 20 points above my entry price. I'm going to be bringing that to my entry price now, right? Because we've had such a sell-off now and it's so aggressive, now I'm more comfortable putting in my trade at my entry price. We're going to go ahead and put my stop in at 23,873. So what I'm going to go ahead and do is, because I'm shorting right now, I'm going to put in a limit stop order or a stop loss to buy back the position at 23,873. So I'm going to scroll up here, 87,000. I can go ahead and click this right here on the bid size after I just said that, but we're getting really close to taking off our position here now. I mean, really, after taking out that low, that could have been another entry just to readjust the profit target and take it out there. But if we take out another low, we're going to go ahead and cover this position. With that being said, we're going to go ahead and cover our position right here. We're going to go ahead and we're going to get flat. Don't be greedy, Errol. Just take it. Come on, back to the lows. Back to the lows. Thank you. Back to the lows. Thank you. We're going to go ahead and cover right there. So we're going to get flat our position. We covered maybe a point or two before our profit target. There we go. There's our actual profit target right there. It's just like, imagine I'm recording this in 2 points before the profit target. We just rip. And there I go. My emotions as a human on full display right now. If this helped your trading, hit subscribe, and I've got more of these tests coming.